Welcome to Briskie Business. My word, can you believe it? This is episode 8. Wow, 2 months of episodes already. Thanks so much for inviting me into your home every Wednesday, joining me for a cup of great coffee and conversation. This episode is going to be a little bit different. In our 8th episode, we're going to change it up a little bit because I've gotten a lot of questions from all of you. You know, and I said it right from the very beginning. The goal of the platform is to help you make less mistakes as you venture in your business career. And what better way to do that than to answer your questions? I want this to be your program. I want to know what's on your mind, and I want to hear from you. And you've been writing me at Briskie Business, ntvUSA.com. That's Briskie Business at ntvUSA.com, and you've asked a series of questions. And I love that because that helps me tailor this program to things that you're interested in. You know, I had only one question this week that did not fit into the 4 segments of the program. And those of you that are watching Briskie Business every week understand that there's 4 specific segments. But we got one this week, and the question was from Irene. Yes, from Irene on the East Coast. And she said, what is the significance of the word brisk within Briskie Business? Why are the segments named brisk, and why are they called brisk bits? So she was curious about that. Obviously, Irene wasn't there for the first program. So you always can go back on the NTV USA app and download that app. And all of the segments and all of the programs for Briskie Business live on that app. And you can go back to episode 1 when we broke that down on what Briskie means. But you know what? It's worth repeating. So brisk actually is a childhood and high school and college nickname. It's funny. My last name's Briskie, obviously, Briskie Business. And the name Brisk just becomes a nickname. You can't help it. It was the nickname of my older brother. It was the nickname of my younger brother. And it was a nickname of me. When I was in high school, at the same time my older brother was there, just naturally, I was Little Brisk. And he was just brisk. And it went that way for my younger brother. So that name, since it is a nickname, the idea and he was just brisk, and it went that way for my younger brother. So that name, since it is a nickname, the idea behind this program was really to soften things up and demystify the stock market and demystify business, and to be a mentorship. And the way to do that is to have to talk to you like a friend. I'm looking for that type of feeling and that type of vibe. So I wove the word brisk into the segment, into the program, because I want you to be relaxed with me. And I want to learn more about you. And I want to be there to build your trust. And so the 4 segments are Brisk Business Basics, which you all know by now, Brisk's Buy or Bail, Brisk Bulls or Bears, and Brisk's Best and Brightest. And so those are the 4 segments. So we're going to get started right away with Brisk Business Basics. And I'm going to change up this program, like I said, and we're going to go with your letters. We're going to go with your questions, and we're going to see if we can answer them. And this first one was titled Salesmanship. Interesting. It says on your third show, you talked about salesmanship and how it was a numbers game. I'm a recent graduate with a degree in communication and have taken my first job with a firm that throws all the newbies into the deep end of the pool, apparently, in a bin and says sink or swim. So they aren't too inclined to help me make a sale. You spoke about sending an email as a follow-up and being short and concise. Thanks for that. But that assumes that I've already met with a potential client and had a conversation about their needs. What about the cold call situation, which is the situation I'm in? How do I get them to take my call? And what do I start off saying? And how is it a numbers game? And that was from Brad from Phoenix. You know, I find it so interesting how in these tough times, everyone runs to revenue. It's just unbelievable. It does really fix almost everything. When things are tough, you're going to see people really leaning on revenue, and you're going to see sales careers take off. We talked about that in some earlier programs. And that's happening right now with this kind of new economy that we're experiencing. So the sales process is becoming really, really important. I went back and I reviewed episode 3 in Briskie Business Basics, and it was entirely devoted to the sales process within the business plan. And I did say that sales was a number game, but I never really expounded on it. So I'm glad that this question got asked today. Several of you asked what I meant by it's a numbers game. In fact, June, Tommy, John, and from the Northeast, Tyrone and Pete from the Southeast, Chelsea and Jack from the West Coast, all asked what I meant by it being a numbers game. And so we've got Brad's question, and I'm going to combine the numbers game question with Brad's question and move right into that. And what a shame, Brad, that your company offers no training. But you know, unfortunately, this is too often the case, particularly when it comes to sales. I don't know why folks don't think that sales is worth training or coachable, but it for sure is. And you'll be probably surprised to hear this. I don't believe in cold calling, but I do believe in prospecting. And what do I mean by that? So how do you prospect and not have it be a cold call? I like to do pre-approach. And what is pre-approach? I think it's extremely important. It worked for me in my very, very early sales career, and it works for our sales team already in the sales process. And it can be done in a number of ways. And what pre-approach really is when you're reaching out to the customer or your target that you're looking to sell something to, and that you have a product or service that can help them. Remember, first thing you got to do is get your mindset right. And selling is a consultative process. So that at the end of the day, your job is to help somebody, and your product can make their life easier. And so that you have to get right. But when I talk about pre-approach, you can do it in a number of different ways. I like, for me, and it's the one that I used back when I was in my early 20s and I embarked on an early selling career, we actually would hand write on envelopes a piece of pre-approach mail. It could be a little brochure on the company, the product, an introduction, it doesn't really matter. But what I've learned is that handwritten notes today, especially because there's so much email and so much social media, these handwritten notes, they get opened actually more often than not. And so you can send those to businesses. And so I like to start off with a handwritten note to my target. I like to email. I like to use a LinkedIn. So if you're in business, I highly suggest you use LinkedIn as your medium for professional business reach outs. It's really the best business social medium. You can make a lot of contacts there. And then, of course, referrals, referrals, referrals. So the goal for you with these pre-approach is that you now have sent a document. So when you make your outbound calls, you no longer have to think of them as a cold call. You can think of it as a follow-up call. Mr. So-and-so or Miss So-and-so or whatever the name might be. I sent you a piece of information last week, and you can then go into your sales approach. I find that a number of times they actually will have seen it, or something in their head because you pre-approach them will help them recognize that, geez, I do know something about that. Even if they threw it away right away, and it went by their desk, somehow it's still in their head. The brain is very, very popular and very, very powerful. So if you use use this pre-approach methodology, the person you're reaching out to, they're going to be almost ready for your call. And I think you'll see your success ratio goes up. So what did I mean by the numbers game? On pre-approach, every week, when I was doing my pre-approach mailings, I had 100 pre-approaches a day, believe it or not. We didn't have much email then, but this was through the mail. And I kind of encourage you each week to do 100 emails, 100 pre-approach mailings, 100 contacts through LinkedIn, and work your referral network as best as you can. Now you know where you're starting from. You'll know you've got 400 pre-approaches every single week. And your goal then is to what? Do your follow-up phone calls. And from there, your goal is to try to set up 4 meetings each day. This is the numbers game approach. If I send out 400 mailings or 400 pre-approach contacts, can I obtain 4 meetings a day or set up appointments for 4 a day? And that can be a phone call today, a Zoom call, a face-to-face meeting perhaps. Any one of those count to be able to present your business, your product, your service, whatever it might be. So if you do that, that's 20 presentations per week. And with those 20 presentations per week, you'll need to keep track of how many lead to a sale. And what you might find is it's just 2, okay? And so this gives you the opportunity to play the numbers game. If it's 2 and you need to make 4 sales, guess what? You're going to either have to get better at your pre-approach phone calling in terms of the amount of meetings you need each week, or you're going to have to put out more pre-approach contact information via mail, social, or email, or ask for more referrals. And use your referral network. Ask people if they know someone in this type of business or that type of business. It's much easier to make an introductory call when someone referred you. Think about that. Hello, Mr. So-and-so, your friend Jason thought you might be interested in what I have. Or I know you went to school with John, and John gave me your number, and he thought you might be interested in what I have. That type of approach you will find will give you a higher appointment ratio and therefore a higher closing ratio. Keep track of the numbers. You should never be without the book. You should never be without the statistics. If 400 contacts a week in pre-approach is not getting you the appointments you need, brush up on your call log, brush up on your message, change them up and see which one gives you a better score and lean on that more. Put out more pre-approach. If 400 isn't getting you to your goal, put out 600 and keep working on your close ratio. You should be able to calculate within 3 or 4 months how much pre-approach you need to put out each week, how many appointments that's leading to each week, and then how many sales that ultimately happens. And you need to work those numbers because sales at the end of the day, it really is a numbers game, and you have to work the numbers. Having those numbers top of mind, that's what's going to make you great. Having those numbers is going to be a scenario that allows you to quantify how much you want to earn. So with that, we're going to close this segment of Business Basics and that wonderful question that you have all asked for me. And we'll be back on Briskie Business with Brisks Buy or Bail.
Understanding your microbiome can change everything you thought you knew about nutrition, digestion, immunity, and metabolism. Ultimate Microbiome by Longevity was specifically formulated to optimize this ecosystem. It provides the advanced support your gut needs through prebiotic, probiotic, and postbiotic supplementation. Our unique blend of probiotics includes Lactobacillus and Plantarum, healthy bacteria, which has been shown to aid in weight loss, sleep, mood, and may even help with seasonal allergies. To enhance digestion, Digizyme Multi-Enzyme Complex, a blend of 5 specific enzymes, has been added to Ultimate Microbiome. It can help break down food so your body can better absorb nutrients. Ultimate Microbiome, the scientific, proprietary, and holistic approach to gut health that helps optimize your body's entire gut ecosystem. To learn more, contact your Longevity associate.
Super Greens is a one-of-a-kind blend that's loaded with hard-to-find nutrient-dense superfoods. We've used what we've learned from our more than 20 years working with mineral-based nutrition to create one of the healthiest, plant-based nutritional products available. Each superfood was carefully selected so that it complements and enhances the others, helping to maximize Super Greens' nutritional power. Next, we added a specialized fermentation technique to increase the bioavailability of each superfood. Finally, we put in powerful probiotics and enzymes for added digestive support to give you jam-packed nutritional support. Youngevity Super Greens, the highly alkalinizing super supplement that helps balance your body. It's the superfood-powered way to get more organic fruits and veggies in your day, all in just one scoop. Check with your Youngevity distributor to learn more.
Paying attention to your overall health also means focusing on the command center of it all, your brain. Factors like stress, lack of sleep, poor diet, a sedentary lifestyle, and the bombardment of pollutants and toxins can all diminish brain and neural functions. When was the last time you concentrated on your brain health? Synaptive by Youngevity is a cutting-edge, unique brain support supplement that delivers powerful nutrients both immediately and throughout the day. Its anti-stress nutrients provide instant brain-boosting support that helps with mental focus and cognitive activity. To enhance your body's neuroprotection, Synaptive's full-spectrum antioxidant blend targets 6 major classes of free radicals that inhibit brain function. This powerful nutrient combination also promotes healthy blood flow to the brain. Synaptive, optimal antioxidant neuroprotection and support for a healthy brain. Now that's something to think about. To learn more, contact your Youngevity associate.
Welcome back to Briskie Business. We're in segment 2 now, Brisk Buy or Bail, and this is the decision-making process. And this program, we're changing it up a little bit. We're taking questions from our listening audience or our watching audience that have been enjoying Briskie Business on ntvUSA.com or on the app. And you've been watching us live Wednesday at 4 p.m. and you've been writing to me at briskiebusiness@ntvUSA.com. And I got a lot of interesting questions, and I tried to categorize them. And so this one's on Brisk Buy or Bail, and let's get right to it. This is on a recent show. You talked about 4 ratios of evaluating a company to invest in. I've been working on increasing my stock position and diversifying as well, so this part particularly interesting to me. I also have 2 teenagers who will soon be going to college, and they've been watching the program with me. Well, thank you for that. That's awesome. A family affair watching Briskie Business. Who knew it? You said the ratios are the liquidity ratio, the quick ratio, the working capital, and the debt to worth ratio. And can you give me a little more information on these, and if there's others I should be considering? Do I need all 4 to be in a certain matrix to be considered a good investment? If so, what is the matrix? And what if there's a plan to be scalable, but they're not doing well in one of those ratios, would I still personally invest in such a company? And that was from Lucy, Colin, and Amy from Houston. The purpose of the ratio discussion was to get you doing your homework. It really was about you understanding that you can reach out and find a balance sheet, and that there's gold in a balance sheet that you can mine there. And it's accessible and it's useful information. And the reason why I picked those ratios is because I thought they were critical ratios for you to consider investing in a particular company. I picked those also because you only needed to know 5 elements of the balance sheet to actually perform the math on all 4 of the ratios. So it's a pretty easy process. The assets and liabilities you need to focus on are current assets, current liabilities, inventory, total liabilities, and net worth. With those 5 numbers, you could go ahead and perform the math on the ratios. And as you remember, the current ratio is current assets divided by current liabilities. And it's a very, very important ratio. It's really saying, does your business have enough assets to meet its payment schedule of its liabilities with a margin of safety? And so I don't think you can really eliminate that ratio. And you want that ratio to be over 1, basically, at a minimum. 1.2, 1.3, all the better. But you definitely don't want to be skipping that particular ratio. And then the quick ratio. The quick ratio is also simple division. It's current assets over current liabilities. So what does that do? That's your acid test ratio. We discussed it in that prior program. And generally, if you can hit around 0.5 to 1, you're good. You're good. You move on. You can consider that particular company. And then the third one was the working capital, which equals current assets minus current liabilities. And that's another liquidity indicator. The reason why we're focusing on liquidity, because that's the amount of available capital or assets you can turn to cash quickly to meet your obligations. So if you're going to invest in a company, you obviously want to know that they're going to be around for a while. And so understanding these ratios is important. 1 or less could mean a future liquidity problem. So if when you're calculating working capital, if you see that's under 1, something you might want to think about and maybe have a little bit of hesitancy on. 1.5 or more, super solid and on solid ground, and they're not likely to have a liquidity issue. The fourth one is debt to worth ratio, and that's total liabilities, once again, division over net worth. And if that thing's under 1, no, you bail. Okay, that's not gonna work for you. And so that's the way that works. Now, you went on with your question to say, well, geez, what if there was something about the company I really loved, or they had a great plan, or they could actually scale in spite of their ratios not being up to par or in our criteria. For me, I look at investing in 2 ways. You need to think about what your smart money's going into. You hear that a lot. There's many, many options. There's many things to consider. But what are you doing with your smart money? And your smart money is the money you're just not going to lose. That's the money that's going to be there. That's that long-term money. Those should be in the most stable of companies. Those should be in the solid companies. Yeah, they should be appealing to you. It would be nice if they had products that mattered to you. All those things would be important. But this is where your smart money is. For me, I think you should at least have 90% of what you're investing in what I call smart money opportunities, lower risk profiles, something that's going to stand a longer test of time. And then when you consider the other 10%, that's when investing gets fun. When you look at the other 10%, we're talking about your friend went to work for a company and you love his company and what he's doing, or maybe your friend went public with a company, but it's just getting started. It's more in a startup phase. In those types of scenarios, this is what I call my fun money. This is the money that if you lost it, you're going to still be okay. I find this interesting, and I know I've spoke about it on other programs, is everybody seems to talk about what they have their fun money in. That's why I call it the fun money. I've really not met too many people that invest, that have the discipline to just invest in that smart money investment. They don't take any chances, any flyers, anything. For them, investing became too boring. I'm not trying to say it's not the right thing to do, but if you can leave yourself a little wiggle room in your investment strategy for that higher risk opportunity that's out there, I think you'll find investing is a little bit more fun. A fun that you're willing to take a flyer on something, but you're not willing to risk any of your smart money, your long-term money, the money that's going to set you up for your retirement. And I think that's the appropriate way to approach the investing strategy. I also received several emails about from the younger population, I guess I would say, that was looking to get started investing, but they wanted to know how they could even open an account. Where should I begin my investment strategy? How do you invest in individual stocks, and all of these types of questions? And for me, it's different now than it was when I was younger and investing. You have all of these great opportunities where you can easily invest without high fees and high costs. And there's a number of apps that offer free investment out there for very, very small amounts of capital. In fact, in no minimums. One of them, I believe, is Robinhood. They even give you referrals if you refer someone else to use the app. And so I think in the beginning phases, I would be looking for that discount broker investment, okay? But keep in mind, I'm talking to you again about your fund money, not your 90%. If you're new out in the business world, right now, you should be focused on your 401k. That's where your money should be going. That's where you should be putting it. If your company matches any part of your 401k, figure out what they match, and you figure out how to live putting that much money into the 401k. Because if someone's going to give you money for free, you take it. And many, many companies now will match a percentage of your contribution into your 401k. This is your first money. This is before you think about investing and opening an account at Robinhood. This is before any of that. Anyone just getting started out there in the business world, inquire about the 401k. See if your company has one. In fact, I would probably discourage someone, if they had a choice between a company with a 401k and without one, from going with the company that didn't have a 401k. That is your shot for retirement, no matter who you are and no matter how much money you make. And the earlier you get started investing in a 401k, the better chance you have for a great and comfortable retirement. So that's step one. Step two, you're going to be surprised that step two is your rainy day fund. Yes, I put investing in your 401k even before saving for the rainy day. You have to get your head right on putting that money away. You have to learn to live without that money you could put in your 401k. And you make sure whatever your company will match you, whatever percentage it is, you get that put in your 401k. And no matter what else is going on in your life, no matter the color and gleam and glare on that beautiful new car you're thinking about, you put all that on the back burner until you max out that 401k. Once you have that figured out, get your rainy day fund figured out, and then we can start looking at the fund money that you've been asking for and start maybe looking at individual stocks. The cool thing about 401ks, the investment is easy and simple. They're all pretty much mutual funds with a large basket of conservative stocks. Your money is automatically put in a safe place, and that's where you need to start off. That's where you go, that's where you make it happen, and that's how you start off your investing career. And so I'm excited to hear from those. My own children, from their very first jobs, they have been maxing out their 401k. They've listened to that, and they've seen how important it has been to them for their savings and really setting them up for a retirement. The quicker you can get money into a medium like that, the safer you are. A real smart person once told me, the hardest $100,000 you'll ever save is the first $100,000. I didn't really know what that even meant. This $100,000 almost seemed unreachable when you're coming out of college. But it's funny, as you invest in a 401k, it just rolls up. But I always stuck in the back of my mind, why is that the hardest $100,000? And then I figured it out when I finally had that first $100,000, because now that $100,000 was working for me, and I was yielding 5 or 10% on that $100,000. So the next time I needed to save money to get to $100,000, I needed to save a whole lot less. So build that nest egg early, build it big, build it broad, keep it invested in conservative portfolio stocks, and you will see your retirement be set up for you. And then you can have fun with Robinhood or that percent and invest in a friend's company or some company you just think has a cool idea. But get it right, and get started. So we're going to conclude this segment, and we're getting ready to move on to public market segment, Brisks, Bulls, and Bears. I'll be back in a moment on Briskie Business. Thank you.
Our NTV USA platform has its own smartphone applications. If you're operating on Android, please make sure to go to the Play Store, search up NTV USA, hit download and install. If you're operating on iPhone or any other kind of iOS operating system, please go to the App Store, search up NTV USA, hit download and install. It's simple, it's easy, but most of all, it's comfortable. There, you'll find notifications to all of our programming so that you can follow us and keep up with all of our shows. And every single announcement that we make here at NTV USA, under every single program, you'll find a link that with a single click will take you directly to the smartphone applications. So what are you waiting for? Enjoy our programming. Stay tuned, stay connected, enjoy a nice cup of coffee. And remember, con una vista, basta.
Cardio Beats from Youngevity supports a healthy cardiovascular system and helps supply the nutrients your body needs to support better physical endurance. Your capacity to last a little longer is largely based on how well your cardiovascular system expends oxygen and circulates blood through your body. Cardio Beats helps combat the oxidative stress caused by physical activity by supplying you with key nutrients that support your cardiovascular system. These nutrients have also been shown to help improve endurance. Cardio Beats starts with organic beets, a rich source of nitrates to support healthy blood flow and oxygen transport. We've added whole foods from highly bioavailable seaweed and mango fruit, both known for blood flow support, and antioxidant-rich sweet cherries. Then, for even more heart health benefits, we finished it off with key amino acids. Take your physical endurance to the next level with Cardio Beats. Talk to your Youngevity associate for more information.
To stay healthy, it's crucial to make sure you get the nutrition you need every day. But it's difficult to get all your recommended vitamins and minerals from food alone. Beyond Tangy Tangerine 2.0 by Youngevity is a simple, convenient, and affordable way to help your body get the essential nutrients it needs. BTT 2.0 supports your body's natural defense system with a proprietary blend of energy-boosting and body-loving nutrients, plus prebiotics, probiotics, amino acids, and enzymes that support digestion. But to get the most benefit and value from any multivitamin, your body must be able to break down the nutrients so you can fully absorb them. Beyond Tangy Tangerine 2.0 was specially formulated with synergizing cofactors to ensure you get maximum nutrient absorption. Beyond Tangy Tangerine 2.0 is the easiest way to give your body the balance and complete daily vitamin, mineral supplement it needs. To learn more, contact your Youngevity associate.
Welcome back to Briskie Business. And this segment is Brisk Bulls and Bears, and we're going to dig in a little more into the stock market. We covered a fair amount of it in the last segment because we had questions that related to it. And I like this program. This program is about your questions, and I love that we're customizing it to what's on your mind. And so I had a really interesting question come up, and apparently I didn't do a very good job in one of the prior segments when we talked about our we at Youngevity, so I'm the president and CFO of Youngevity. I haven't mentioned that in a while, but we're a public company and we trade under the symbol YGYI. And we had made a couple of announcements, and I talked about our stock getting shorted and what that all meant. And apparently I took for granted that everyone understood what shorting was about or what a short position is in your stock. And apparently, a lot of you had questions about that. So I got a number of questions about short selling and if I could expound on what a short selling position is. So I thought I'd cover that at the very beginning here of Brisk Bulls and Bears. Let me take a sip of this amazing coffee. By the way, this is Youngevity Be the Change coffee. The interesting thing about this coffee is this company, Youngevity Be the Change, it gives 100% of the profits it makes on the sale of coffee to a charity. I think that's really cool. So Tastes a little bit better when you know about that. So let's talk about this short selling phenomenon and what it means, and if I can expand on it. And I'm going to get right to it. So it is complicated now that I think about it. So let's talk about what isn't short selling. In other words, buying a stock. So this is a stock that you would just go out and you would acquire. So it trades for, let's just say, $10 a share. You want to buy 100 shares, and so all of a sudden you've got $10,000 worth of stock and you own the stock. And what do you want the stock to do since you own it? You want it to go up, right? That's what most people think about owning a stock is. I buy a stock, it has a value, and I want it to go up, and so that's how I'm going to build my portfolio. I am an optimist. I like to see stocks rise, and that's how I build my portfolio. So what is this idea of short selling? Well, this is a situation where you think a stock is going to go down. You may think the company is overvalued. You may think the company isn't worth the price it's trading for. And you're like, geez, it would be a good investment for me if I would short the stock. In other words, play the stock so that if its share price fell, I would make money. So you're playing a stock down. So this is a little bit different thinking, and it is fairly complicated because you're essentially selling something you don't own. That's what shorting is. You're selling stock that you don't own in your investment account. So what you're actually doing is you're going to borrow the shares from your brokerage account. So you have to have a brokerage account to do this. You have to have what they call a margin account to be able to short a stock. And then you are selling shares that you actually don't own yet. So what you're doing is you're borrowing the stock from your brokerage account, as I said. So let's just walk through some simple math on this, because I think it'll start to make better sense when you see like a practical application. So let's go back to the 100 shares of a company example. And they're $10 per share. And you think there's no way that that company stock should be worth $10. I did the quick ratio, I did the current asset, I did all of this stuff. I know that it's overvalued. I've done a peer study. In other words, I looked at its competition, and based on the valuation that this company has in terms of its revenue and its balance sheet, it's way overpriced. So I think it's going to go down, and I want to short it. So 100 shares, $10 a share is a $1,000 investment. So you essentially sell, you sell 100 shares that you don't own. So you borrowed it from your brokerage account. They have shares there, and you've sold these shares that you don't own. So now, what do you have to do to make money? So in your margin agreement, most margin agreements call that you have 35% coverage when you short a stock. And what that means is if you invested $1,000, like in our scenario, 35% of $1,000 is $350. And in your brokerage account now, you have to have $350 of cash to be able to do this short trade. They want to make sure they're covered, your brokerage account. They're not going to take this risk. So you have the opportunity or obligation to actually buy these shares, right? Because that's how you're going to make money. You've already sold them, but you didn't have any shares to sell. So at some point, you have to buy the shares to sell them. So what happens in this scenario if the stock goes up? That's interesting. So instead of it now at $10, it's now $15. You have your 100 shares of stock that you sold already, and now it's at $15 a share. What's the math? $15 times 100 is now it's $1,500. So you paid $1,000, right? You had to have your 35%, right? Your margin account. You had to have $350 of cash in your account, but now the stock went up. And now it's $1,500. So your brokerage account's going to say 35% of $1,500 is $525. So we need to make a margin call from you, Mr. Short Investor. You need to put more money so we're safe in our loaning you those shares that you've already sold, that you owe us for. And you have to cover that. You had $350 in cash. I need you to get your account to $525 in cash. So you essentially would have of the spread of $175 that you have to cover. So That's the way it works on the upside. On the other way, why is short selling considered more risky? Yeah, it's more speculative and more risky than long selling. And a lot of people, I say that, go, why is that? Well, let's walk through the scenario. If you're playing the long market long or short. So the potential gain, let's go back to our $10 stock, okay? So you bought, for 10 bucks, you bought the 100 shares, right? So we got 100 shares, that's $1,000. What happens if the stock goes to zero? You're playing it short, remember? You're playing it down. So if the stock goes to zero, you invested $1,000, right? The stock went all the way to zero. That's your dream, right? So you can buy the stock back at zero. So your 100 shares is worth $1,000. Because what did you now pay for the stock when you covered? You paid nothing. So you made $1,000. You keep that $1,000 and you made $1,000. So that's pretty interesting. But what if the stock, if you're shorting it, goes the other way? This is where the risk, and this is why you hear about shorting being an interesting opportunity for investment. And I can go into a whole program on shorting. But if it goes the other way, and I'll give you a stock symbol, Tilray, T-L-R-Y. Look at its chart about a year and a half ago. It's in the hemp space. The hemp space got really hot. And people got decimated on Tilray. Tilray went from $10 to $100 a share. So think about that. What if you shorted it in the scenario we just brought up? You had an opportunity to make $1,000, but Tilray went to $100. Now you've got to figure out how to come up with $30,000. 100, right? $100 a share. It's $100,000. My goodness, $100 a share times your 100 shares. Wow, you can really lose money quick. Tilray actually went all the way up to $300 a share. So do the math on that. So shorting has unlimited downside. Unlimited downside, okay, for the investor. The upside is what I just went through. Now, those that shorted Tilray when it was at $300 a share, if you had the staying power, if you had the money to short Tilray at 10, short it again at 100, keep covering your margin calls, short it again at 200 a share, and short it again at 300 a share, eventually you would have been richly rewarded, because that stock right now is trading at about $8 a share. Can you imagine how well the shorts did on that investment? But it's interesting, you really need to be paying attention when you play in the short game. So the next question I had was on ETFs and mutual funds. And this came from a number of people. Mark in Seattle asked a question, and there were several other listeners asking a similar question about ETFs, mutual funds, and index funds, actually, including Hank and Jeff and a gentleman named Pietro, said, are they things I should invest in, and what's the difference? They're actually very similar. An ETF is an exchange-traded fund. A mutual fund is a bundle of stocks, and an index fund is a bundle of stocks that trades against an index, like the Standard & Poor's index. I like all those as investment vehicles because it's a diversified portfolio for you. It's a bundle of stocks. Many people think when they said, no, I have heard people say this, especially younger people, I don't invest in mutual funds. Well, mutual funds is a bundle of stock, and you hear that all the time. But it's nice and diversified for you. So that's a great way to start off your investing career in that type of opportunity. In your 401k, you're likely to be buying a mutual fund or an index fund. So we're going to close it up right here on Briskie Business. I love this segment of public markets, but my favorite segment is coming up next, and that's Best and Brightest. We'll be right back on Briskie Business after a word from our sponsor.
More and more healthcare professionals and people seeking alternative and natural health treatments are turning to hemp-based products because of the growing body of research supporting its benefits. Youngevity has leveraged our years of natural plant-based nutritional research to introduce 3 new products. Hemp FX Soothe helps support muscles and joints by enhancing a healthy immune response and reducing free radical stress. For optimal results, it contains our hemp-derived CBD plus the powerful antioxidant glutathione. Hemp FX Relax helps ease the mind and the body for a deep and restful sleep. We combined our hemp-derived CBD with melatonin to help support your best night's sleep. To help support positive energy for your mind and your mood, we created Hemp FX Uplift. In combination with St. John's wort and a specialized set of terpenes and cannabinoid enhancers. To learn more about Hemp FX, contact your Youngevity distributor or visit
Cardio Beats from Youngevity supports a healthy cardiovascular system and helps supply the nutrients your body needs to support better physical endurance. Your capacity to last a little longer is largely based on how well your cardiovascular system expends oxygen and circulates blood through your body. Cardio Beats helps combat the oxidative stress caused by physical activity by supplying you with key nutrients that support your cardiovascular system. These nutrients have also been shown to help improve endurance. Cardio Beats starts with organic beets, a rich source of nitrates to support healthy blood flow and oxygen transport. We've added whole foods from highly bioavailable seaweed and mango fruit, both known for blood flow support, and antioxidant-rich sweet cherries. Then, for even more heart health benefits, we finished it off with key amino acids. Take your physical endurance to the next level with Cardio Beats. Talk to your Youngevity associate for more information.
Paying attention to your overall health also means focusing on the command center of it all, your brain. Factors like stress, lack of sleep, poor diet, a sedentary lifestyle, and the bombardment of pollutants and toxins can all diminish brain and neural functions. When was the last time you concentrated on your brain health? Synaptive by Youngevity is a cutting-edge, unique brain support supplement that delivers powerful nutrients both immediately and throughout the day. Its anti-stress nutrients provide instant brain-boosting support that helps with mental focus and cognitive activity. To enhance your body's neuroprotection, Synaptive's full-spectrum antioxidant blend targets 6 major classes of free radicals that inhibit brain function. This powerful nutrient combination also promotes healthy blood flow to the brain. Synaptive, optimal antioxidant neuroprotection and support for a healthy brain. Now that's something to think about. To learn more, contact your Youngevity associate.
Welcome back to Briskie Business. This is my favorite segment. I call it Brisk, Best, and Brightest. And this is a segment where we really get into mentorship. But on this program today, we're answering our listeners' questions. And we got a number of questions, and I think some of them fit pretty well in Brisk, Best, and Brightest. So, join me for a cup of coffee during this segment. Relax, kick back a little bit, and let's dig into some of these great questions that our listeners have. I tell you, we got some smart minds out there watching Briskie Business. So this person asked actually 3 different questions. So we're going to cover all 3 of them. So it said, the topic I would love to cover in one of your episodes is management style. And he said he just became a new manager. I'm not going to name his company, but he said in a company, I think the company is located in Texas, or at least he is. And he said, I'd love your tips on a few of these topics. And these questions came in from Bobby. And so I don't know if Bobby's a male or a female, because that name goes either way. But you know what? The advice and the question works no matter what. So the first part of the question was, how do you develop into the correct management style to your personality and job? Wow, that's a really, really interesting question. And we've covered this on other programs to a degree, but we didn't actually answer this question so pointedly. Knowing yourself is the first step. If you want to be a successful manager, you got to know who you are. You got to know what matters to you. You have to know how to be your best you, your genuine you, which is the key. Because at the end of the day, those that are wanting to be led by you or being led by you, they're going to know if you're genuine. They're going to know if you're being real. You can't be a different person that's going out for dinner or a different person that's at a social event that's in the office. It doesn't make any sense. Yes, there's certain behaviors that are required within a company culture. For example, you might enjoy a happy hour cocktail, and maybe your company doesn't allow drinking on the job. But that shouldn't alter your personality. And if it does, you might want to think about that for a bit. But knowing yourself is the first step in developing the correct management style for your personality, because you don't change your personality. Your personality is who you are, and being true to yourself is going to be your key to not only enjoying yourself in the workplace, but more importantly, finding people that want to flock to you or follow your leadership. God, people love to follow genuine human beings, and you'll see it all the time. Sometimes you just can't put your finger on it, and you just realize that's just a genuine guy or a genuine girl. I like being around them. The reason why you like being around them is they're comfortable. They're comfortable in their own skin. You sure do need to understand your company as well and its culture, Bobby. That's a really, really critical piece. What is your company all about? One of the things I think is so important as you venture into this new role that you're talking about as a manager, do you understand what everyone's doing? Are you willing to roll up your sleeves and understand how those people are involved in the company and what their roles are? Because that is going to be critical for you to manage other people. My dad taught me something when I was at Fordham University and I came home in the summers. One of the things he did is he took me out on sales calls because he realized I wanted to be in business. And he stopped, and we were going to go see his biggest account. And there was a gentleman there in the shop before we went up to see the boss who would be making the purchasing decision. And my dad stopped and had this conversation with this gentleman who really was just pushing a broom and kind of cleaning up. And I was amazed by how much time he spent with this guy sweeping the floors. And I asked my dad, I said, you seem to take an awful lot of time with this person, and yet, you got your account waiting upstairs. And he says, Dave, I've been doing this a long time. And one of the things I know for sure is it's a whole lot easier to be nice to people, for one. So there's a payback no matter what. And that guy that's upstairs that's making this buying decision, he was sweeping the floors the first time I met him. He really taught me a valuable lesson there. First of all, there's no harm in being good to other people. But second of all, you don't know where these people are going to be in life. And if you treat them good along the way, that can be great for your career. But more importantly, it can just be great for that guy sweeping the floor when he goes home with a smile on his face. So treat people with respect, I think, is the first answer there. But make sure you're doing it throughout your company, right? Bobby, that's key. Do you know everyone there? Do you know about them? Do you care about them? You want to lead people? Show them you care about them, and they'll follow you. These are really, really important management steps. The second thing, and you're going to be flipped over this one, every management book I've ever read talks about the rule of arm's length relationship. Keep your employees at arm's length. Don't get in close. I threw that book away. Don't believe in it at all. I've gone my whole career violating the rule of arm's length relationship. I like to enjoy my work. Now, if you're going to be that person, you're that type of social person, and you want to violate that rule, you have to set up a standard for your team. You have to tell them that you're going to violate that rule. You have to tell them that you have no issues being a friend with people in the workplace, even a friend to people they manage. And you have to tell them that if the relationship deteriorates, it won't be because of you. It will be because of their issue having you as their manager and being confused as when they can be a friend and when they have to understand your position of authority. That is so critical. I've done that my whole career. I've given that speech. And have I lost a few people? Yeah. But let me tell you something. I've kept great teams together by being their friends and them understanding and respecting that rule of arm's length relationship is not something I follow, but I need you to understand my position of authority and responsibility. And please respect that. And we can have an incredible relationship. And it's worked very well for me. So for me, violate the rule of arm's length relationship, but make sure you can pull the trigger on those that can't accept the fact that you're in a position of authority or that you might be their boss. The best managers I've ever seen never pull that card. They never have to pull that card. They never have to say they're your boss. They get the work out of you because you respect them, because they like the environment they're in. Managing those expectations are absolutely critical to becoming a great manager. You know, I've looked at it so many different ways, and that is the key. One of the things I love to do is joke around in the workplace. So how are you going to manage that expectation? And I'm a Briskie, and Briskie are sarcastic people, so we use sarcastic humor. So sarcasm can sometimes backfire on people. So everyone I've ever employed and anyone who's ever worked for me has this speech to them. Hello, whoever it is. I want you to know that I love to have fun in the workplace. I want you to know sometimes I can say sarcastic things, and sarcastic things can be hurtful if you don't realize it's a joke. And you need to understand this. If I ever have a serious discussion we need to have about challenges in the workplace, any issues that I have with you, it will always be in my office with the door closed, one-on-one. Every other time, it's just sarcasm and having fun. So if I say something off-putting in front of 4 or 5 people, I'm just joking around. Don't ever walk around wondering if there's an issue with me in the position I'm in, unless we've had that conversation, closed door, because that's how I want our environment to be. Happy, go lucky, getting job done while having fun, smiling in the workplace, cutting up and joking around. That creates a great environment. And I give you that advice, and it works really well, but you have to set the expectations once again. One of your other questions you asked was, what were my regrets or my pitfalls as a seasoned manager? That's an easy one for me. I've made the mistake a few times. Integrity is everything, and setting the proper chain of command, as I've advised. But when an issue happens, it's hard to address issues. Letting them go too long is a big problem, a very big problem. So that, to me, is my biggest regrets, is when I've known there was an issue and didn't address it at once. Oh, I'll let it go. Maybe it'll change. It doesn't change, it just gets worse. And by condoning that type of behavior, you're setting up for a very, very bad pattern. So addressing those things as soon as they happen. And I'll leave you with this tip. Now that you're a manager in your new career, which, by the way, congratulations. That's a heck of an achievement. That means you'll be hiring people. And this is my tip to you. It's hard to figure out who the right people are to hire. Where you make the big mistake is when they're the wrong people and they're in your company. You make those teams solid on the fire. The minute you know they're not the right person for your team, it's time to let them go. So that's it. We're going to wrap up Briskie Business. This has been a great episode for me. I appreciate all the questions. And that's it for episode 8 of Briskie Business. We'll see you next week.